2, 1, ready.
Okay, hello everyone. My name is Alejandra and this is Group 1. Today we're presenting our financial analysis project for Tesla, which we've been working on for our class. We focus on Tesla's financial reporting and analysis over the course. We've developed a detailed Excel model that not only evaluates Tesla's current financial health, but also forecasts its future financial performance. Next, please. Okay, so if you can see in this slide, we are going to present the agenda for the day. The first that we're going to present is the profile and the history of the company, then the strategy analysis, the third, the accounting analysis, fourth, the financial analysis, five, the forecasting, and last, the valuation. Next, please. Yes. Okay, so for this slide, we're going to talk a little bit about how Tesla began and how it was created. So in 2003, a vision was born in the form of Tesla Motors, Inc., the brainchild of Martin Eberhard and Mark Tarpenning. It was just not only about cars, it was about accelerating the world's shift to sustainable energy. Then soon after, in 2004, Elon Musk came into the picture. He was leading the Series A. He became part of the board. And now it was like a new era for Tesla. And now it was not called more Tesla Motors Inc., and now it was Tesla Inc. So next in 2017, it was the rebranding. Yeah, the company changed to Tesla Inc. And then in 2010, they went public in June 29. The stock price came out of $17 per share. And in 2021 to 2024, what there's been doing is they are being evolving, and the company have created this strong identity, so leading the market of the electric vehicles. Next, please. Okay, so here we can see general data. First, we have here the revenue that Tesla had from in 2023 of 96.8 billion. The net income in 2023 is about like 15 billion. The stock performance experienced a significant volatility right now. And at the week 52, the range was in 152 and 299 as of 2024. The products and services, they manufacture and sells electric vehicles and solar panels and batteries for cars and home power storage. The segment operations, they are in the automotive and energy generation and storage. They have an employee count of over 140,000 employees. They have global presence in manufacturing in the US, Germany, China, operations in Asia, Pacific, and Europe, and the headquarters were moved to Austin, Texas in the US. The next slide, please. So right now we're going to understand the Tesla's 5-quarter analysis. So to understand Tesla's competitive environment, let's dive into these forces. So we have the first one, the threat of new entrants. So the threat of new entrants for Tesla is moderate to low, thanks to the high capital investment requirements and the advance in technology involving electric vehicles, which act as a significant barrier to entry. The second one is the bargaining power of suppliers. So moving to the bargaining power of supplier, it remains moderate for Tesla. While there's a multitude of suppliers for traditional auto components, Tesla needs for specialized batteries and tech components give suppliers some degree of power. The bargaining power of buyers. So Tesla now faces since the creation, they faced a moderate bargaining power of buyers, since customers have other electric vehicle options, but Tesla's brands is very strong, and the product quality offers a certain resistance to price changes. But this is like what been happening the past years, but now it's changing a little bit. And the threat of substitute products, although Tesla is a leading position, the threat of substitutes is high with various transportation methods and upcoming tech like e-bikes, scooters, that are providing like alternative mobility solutions. And the rivalry among existing competitors. So we see a high rivalry among existing competitors with intense competition from both established automakers and the new companies entering the electric vehicle market. So next, please. And then for the Tesla's strategy, you can see here that is a mixed strategy. They center the strategy in differentiation and cost leadership. So they are the innovation in the electric vehicle technology. They have a high performance vehicle offering, a unique vehicle design aesthetic, and a widespread and convenient supercharger network that is like what differentiate them of the market. And the cost leadership, they have ongoing efforts to reduce the cost of batteries, optimization and manufacturing of processes for efficiency, supply chain management, innovations, and competitive pricing strategies for its electric vehicles. Next, please.
In this slide, we'll take a look at Tesla's financial health. We'll cover Tesla's assets, liabilities, and shareholders' equity, and discuss what these numbers mean for the company's future. Tesla's assets, they have a strong asset base of $106.6 billion in 2023, with a 29% growth from the previous year. This provides a financial cushion to fund future growth initiatives and operational activities. Tesla's assets increased by 29% in 2023 to $106.6 billion. This strong asset base, I already said that. A strong asset base is a sign of financial health, as it indicates that a company has the resources it needs to cover its liabilities and invest in its future. The total liabilities for Tesla is $43.9 billion in 2023, with a 18% growth from the previous year, with the assets representing 41.18%. Moderate use of debt financing is what we see after doing a thorough financial analysis. With the increase of Tesla's liabilities, they're still at a debt to asset ratio below 1, which is generally considered to be a good sign. That indicates the company is not relying too heavily on debt to finance its operations. With their shareholders' equity, they have an equity of $62.6 billion. And we can see another big substantial growth of 38% from the previous year. This demonstrates a strong capital base to support future growth initiatives. The shareholder equity is the difference between a company's assets and liabilities. It represents the amount of money that would be left over for shareholders if the company were to liquidate its assets and pay off its debts. So we have Tesla's, as we can see after this analysis, Tesla's financial health is strong. They have a very strong asset base. It's a moderate use of debt financing quarter to quarter, and they also have a strong capital base. We can conclude that Tesla's financial health is strong, and the future for Tesla is bright with potential of a lot of future growth. It's important to note that this is just a snapshot of Tesla's financial health at one point in time. Things can change. It's a very liquid market. The company's financial health can change over time, so it's important to stay up to date on the latest developments. Next slide. On this slide, we're going to cover Tesla's profitability and go over their return on assets, which is showing that they effectively use their assets to generate profits. Tesla's ROA saw a significant improvement from 2021 to 2022, indicating they were getting better at utilizing their assets for profit generation. However, it's important to note that there was a slight decline in 2023. The profit margin is a metric of profitability relative to the revenue, and it has been consistently increasing until 2022 and remains stable in 23. This indicates Tesla has been efficient in controlling costs and generating profits from its sales. Onto the return on equity. The ROE measures the return on investment for shareholders. It shows how much profit a company generates for each dollar of shareholder equity. Tesla's ROE experienced a remarkable increase in 2022, likely due to the combined effects of increasing profitability and a potentially changing capital structure, which would be the debt versus equity. The moderate decrease in ROE in 23 could be due to fluctuations in profitability or changes in investment strategies. Overall, we have a high ROA and profit margins, which are both a positive sign, indicating efficient asset utilization and strong operational performance. The fluctuations in ROE can be caused by various factors, including changes in how Tesla finances its operations and its investment strategies. It's important to analyze ROE in conjunction with other financial metrics to get a complete picture of Tesla's financial health. Next slide.
Okay, thanks, Ren. Now we are going to talk about the financial analysis. Like Ren already started that analysis, we are going to do a little zoom in some variables. So we are going to talk about radio analysis and industry comparison. We are going to talk about the value drivers and also the Tesla's strategy reflected on those numbers. So first, talking about return on assets again, we will now also take a look to the asset turnover, which has been mostly constant, but had a slightly decrease from 2022 from 2023. So maybe that's part of the return on assets having a slight decrease too from those years. But asset turnover keeps growing across years, except on 2023, possible due to new gigafactories that produce more assets and sales are not catching up yet. So Tesla is constantly doing more factories which have better technology each day to reduce the profit margin with better control of cost. But there is a moment when they are producing more assets than the sales that they are doing. So in those transitions is when the asset turnover can slow down a bit. Now doing an industry comparison of the return on assets, we can see that Tesla does way much better than Lucid and Rivian, which are also manufacturers of these type of cars, of electric cars. One reason of this is because Tesla's competitors arrived to the market more recently. So if you go to the Tesla financial statements in the beginning, like in the first years, they were having like negative return on assets, like they started to have like a positive return on assets like after the 7th year or something like that. So maybe that's something that can happen. But yeah, the competitors are not doing that well for sure. Also, in terms of return of common equity, like Ren mentioned, this takes into account leverage, and basically Tesla is using leverage like responsible, and that's why they have like a constant leverage index, but return on equity is almost increasing all the time, except for the last year, as he mentioned, and as we can see here again. So another important thing that we wanted to mention is that return on common equity is greater than return on assets on every year after 2019. So return on assets is higher than cost of debt and preferred stock financing. Tesla makes good use of leverage. Now again, seeing the competitors, like there is no such difference against return on assets. Like Tesla does way much better than its competitors. Rivian and Lucid are still burning more investment resources than generating sales. Tesla started to have a positive return on common equity from 2020, and it became public on 2010, as a matter of example. Now Tesla's strategy, basically they have like a direct to customer approach for distribution. They don't have like car dealership deals like other brands like Toyota, Ford. They are different. They negotiate direct with the final customer. So that helps the profit margin because they can have better margin negotiating directly without more parts in the middle of the deal. Also, supply chain optimization helps the profit margin. So research and development helps supply chain processes to be more efficient. For example, cheaper batteries. Also, Tesla negotiates with suppliers using high bulk discounts, which help them have a better price. And as I mentioned before, like the new gigafactories help the asset turnover in a long term, not in a short term, as we saw in the graphic of return on assets. But constant investment in more efficient gigafactories can slow asset turnover in the short term, but in the long term, they will be able to deliver more cars while also having sales growth. Also, we wanted to talk about the diluted earnings per share, which shows from 2019 to 2023 a strong indicator of financial health and operational success. Tesla's focus on scaling its operations and improving manufacturing efficiency, and is paying off. As production of electric vehicles and energy products has scaled up, and as the company has become more efficient, its ability to generate profit from its operations has significantly improved. We wanted to also mention that they are also having like a weird behavior nowadays because looking into Yahoo Finance, we saw that the current EPS for this year is 3.9, which is decreasing against the 2023 value, which is 4.2. So yeah, they are having like, they are struggling with some, they needed to low prices. So maybe that's some of the reasons that why they are not doing like so well nowadays. And we will talk more about that in the next session. Also, finally, in terms of short-term liquidity, we can see the current ratio and the acid test ratio. These figures indicate that Tesla has been maintaining a reasonable level of liquidity with the capacity to meet its short-term liabilities, even when excluding less liquid assets like inventories, which is the acid test, basically. Tesla's financial health in terms of liquidity has been solidifying, reflecting a positive trend in managing its short-term financial responsibilities more effectively year over year.
Oh, yes, so now we come to the forecasting section. In order to come up with the forecast assumptions, we reviewed the financial information for the past 5 years and also reviewed some analyst predictions in the Yahoo Finance platform. Tesla's revenues are composed by 3 segments: the automotive, energy generation, and storage, and services and others. Tesla automotive segment is the main revenue generator for Tesla. 85.2% of the revenue in 2023 came from this segment. The automotive segment gets its revenue from car sales, car leasing, and regulatory credits. Tesla announced that its vehicle volume growth rate will be notably lower in 2024 as it continues to work on the launch of next generation vehicle at Gigafactory Tesla. So we definitely took this into consideration when forecasting for the sales. The services and other segment in 2023 was 8.6% of total revenue. So this segment is it's small compared to the automotive. This segment obtains revenue from repair and maintenance services, warranty services, and used vehicle sales. Also sales of merchandise and components, sales of insurance, and sales of supercharging. The success of this segment, it's heavily reliant on the strong momentum of vehicle sales. Without new vehicle sales, Tesla service segment may not achieve the same level of success. The energy generation and storage sales revenue was only 6.2% of total sales in 2023. This segment consists of sales of solar energy system and energy storage system to residential, small commercial, large commercial, and utility grade customers. Although this is the smallest segment for Tesla, CEO Elon Musk during the Q4 2023 earnings call, he said that this segment will grow much faster than the car business. So we have, after taking all of this into account, we have been conservative in terms of a year-over-year revenue growth for 2024 and 2025, due to the current scalability problem that Tesla is facing. So we have projected a total of 7% sales growth in 2024 and 14% in 2025. Nevertheless, we believe that Tesla's current problems are short-term, and the company will make advancements in electric vehicle technology, autonomous driving capabilities, and sustainable energy solutions by 2026. And that's the reason that we project a 37% year-over-year growth thereafter. For the cost of goods sold, we estimate it will be at 73% of sales for the next 5 years. This is 8% lower than it was in 2023. And the reason for the decrease is the layoff of 10% of Tesla's global staff and Tesla's emphasis on streamlining production processes and reducing costs overall. So this cut in the cost of goods sold leaves us with a strong gross profit. A 58% growth is projected in 2024 compared to 2023, where it actually decreased by 15%. The selling, general administrative expense, research and development, and restructuring other, we estimated to be an average cost as a percentage of revenue for the past 5 years. Interest income, we use an average earning as a percentage of revenue for the past 5 years. To calculate the interest expense, we use the long-term debt notes provided in the latest 10-K filing. We identified the face value of each note, calculated the proportion of total debt represented by each of those notes, looked up the stated interest rate for each note, then multiply the proportion of debt by the stated interest rate for each note, and we sum up all the results to get the weighted average interest rate. On the income tax expense, we use the average tax rate implied from the income statements for the years 2020, 2021, and 2022. We did not use 2023 because that year Tesla benefited from a release of $6.54 billion of valuation allowance in deferred tax assets. So in 2023, instead of taxes being an expense, they were a credit of $5 billion, which kind of inflated their net income as a result. So at the end, the 2024 net income decreases at 15%, but it is really due to the tax benefit that Tesla used in 2023. Therefore, net income growth is the same, it's projected to be the same as the sales growth. You can go to the next slide. So for the balance sheet forecast for the current assets, such as the cash equivalents, short-term investments, accounts and notes receivables, and prepaid expenses, we forecast these items as an average percentage of total assets using the past 5 years data. Due to scalability constraints, we project inventory to grow at 5% in 2024 and 10% in 2025. For the subsequent years, we apply the compound annual growth rate of 34% based on historical trends. The long-term assets were also forecasted as a percentage of total assets, except for property, plant, and equipment. For PPE, we projected growth using a 5-year compounded annual growth rate. Tesla Giga Mexico is currently being built and is expected to be the biggest electric vehicle plant in the world. Tesla's actual manufacturing capacity is of 2 million units per year, and the company long-term goal is to achieve 20 million cars per year. I don't know if that's possible, but you know, Elon Musk, it's in another level. This means that several more gigafactories might be announced in the coming years. So overall, the total assets projected to grow from 106 billion in 2023 to 224 billion in 2028. The year-over-year growth rate ranged from 12 to 19%. For the liabilities, we assume a 17% growth rate for current liabilities in 2024 and 2025. For subsequent years, we apply the 34% compounded annual growth rate based on past performance. The current portion of long-term debt and total long-term debt were projected to increase by 50% in 2024 to support Tesla's expansion plans, which require additional funding. Thereafter, we assume a 10% decrease rate. Paid-in capital, we assume a growth of 8 to 9%, similar to the growth rate of 2021, 2022, and 2023. Retained earnings were forecasted by adding net income, assumed dividends, and total treasury stock purchases. They're forecasted to increase from 27 billion in 2023 to 42 billion by 2028. So in conclusion, the balance sheet forecast suggests that Tesla is expecting to continue its growth trajectory with both assets and liabilities expanding. The growth in current and total liability tells us that Tesla plans to finance its growth through additional debt. The steady increase in shareholders' equity also tells us that the company is expected to remain profitable and continue to reinvest in earnings into the business. Next. So this is the implied statement of cash flows. After completing the forecast for the income statement and the balance sheet, we obtained this cash flow statement. The forecasted net cash flow from operations shows a steady increase from 2024 to 2028. It growth from 16.8 billion in 2024 to 47.7 billion in 2028. And this indicates that the company's core business operations are expected to generate significantly more cash over time, driven by factors like revenue growth and working capital management. The forecasted net cash flow for investing activities shows a consistent outflow of cash, increasing every year. In 2024, the outflow projected is 10.9 billion and growing every year by 18.8%. And this suggests that the company plans to make substantial investments in areas like property, plant, and equipment, and other assets to support its growth. The forecasted net cash flows from financing activities show a mix of inflows and outflows. The negative values show net cash outflows, primarily driven by dividend payments. This increase in outflows tells us that the company also plans to return cash to the shareholders over time. Overall, the forecasted cash flow shows a strong and growing cash from operations to fund the rapid growth of the company. However, it's important for the company to remain it's important to note that the company also remains a heavy capital expender with large investing and financing cash outflows. So Tesla needs to focus in remaining and having a positive free cash flow for a long-term success. Next. So we did a forecast of the earnings per share. The forecasted earnings per share was calculated using the basics earnings per share formula. This formula determines the earnings per share by dividing the forecasted net income by the forecasted weighted average numbers of basic shares outstanding. In forecasting the weighted average share, we incorporated the impact of the planned 20 billion in share repurchases. To estimate the number of shares that could be repurchased with this amount, we used the previous shares price adjusted for the expected growth rate in earnings per share. Specifically, the estimated repurchase price was calculated as the previous period's share price multiplied by the gross rate of net income plus 1. This method provides a dynamic estimate that adjusts the repurchase price based on financial performance expectations. The forecasted earnings per share graphs here shows that Tesla expects a short-term dip in earnings per share in 2024, followed by a recovery and a strong growth in the subsequent years. The decline in 2024 reflects the temporary challenges that Tesla is facing. Nevertheless, starting in 2025, the earnings per share is expected to recover and grow significantly each year. So this indicates that the company anticipates overcoming any shortcoming challenges and expects substantial growth in profitability. Next. So we use the valuation FSAP package template from Class, which automatically calculated the share price for each valuation method. The estimated prices provided by these valuations model for Tesla suggest a consistent undervaluation compared to the current market price of $168.29. Each of these models estimates a share price significantly lower than the current market price. This discrepancy indicates that it's pricing Tesla's share higher than what traditional valuation models suggest. We believe this is due to factors not fully captured by this model, such as market sentiment, future growth potentials, or Tesla's innovative edge in technology and electric vehicles. In the 2024 Q1 earnings call, Elon Musk mentioned the potential release of a robotaxi by August this year, and shares jumped 6% thereafter. So market sentiment is really plays a big role here. Given the consistent undervaluation across these multiple financial models, we believe a cautious approach will be advisable. The recommendation will be to hold if you are a current Tesla investor. This is based on the potential for Tesla future growth and market leadership in electric vehicle technology and energy solutions. And for potential buyers, if you're a long-term investor, we also recommend a buy because we believe that purchasing shares at the current price still yield a long-term benefit. Although the earnings per share were forecasted to take a dip in 2024, as we previously discussed, the forecast also shows a recovery and a strong growth in the following years. Thank you.